With that being said, Dr. Christopher Thornberg, we've had the pleasure of seeing him many, many times. And here you go.
All right. Hey, you know, he looks so uncomfortable. I feel like I had to relieve him on stage here. Okay. Let's see. There you go. See, that wasn't so hard, was it? You know, I'm listening to that last conversation, and I'm thinking, like, I got to put a couple things in there, and maybe I'll take a couple things out, and this is just part of my issue. I'm always finagling of these particular things. It is lovely to be with you. Of course, as you noted, I'm an economist. My name is Chris Thornberg. I have a company called Beacon Economics. We're based here in California. What the? Don't do this to me. All right. I have no idea why it's doing that. Hopefully the rest of my presentation won't be similarly screwed up. Is it just this one? Okay. Well, we're not going to worry about it. You know, it is one of these days, as they say, so to speak. So let me get right into it. I have a company called Beacon Economics. We're based out of LA. I do really work all over the United States. But, you know, my company's, I think, primary claim to fame is the basic idea that what we do is we tell people stories based on the numbers rather than making the numbers conform to our particular story, as the case may be. And on that particular basis, when you focus on the numbers, I think you come up with a different view of what's happening in the world. And what you're going to see through my entire presentation today is this basic theme. There are really two kind of stories to talk about today. One story is what we think is happening in our economy, that you might call the social narrative, or what somebody else might call their lived experience. The other part of that, of course, is what's actually happening, our economic realities. Now, I would tell you that those two things should be the same. When I went to grad school for economics, we were taught about the rational agent, the person in the bottom of this pile of models who internalizes information and makes logical choices. Then I got out of school and looked at humanity and said, "You're kidding me, right?" That was a joke, people. Come on, really? Lighten up. Anyway. The whole point here, of course, if you want to understand what's going to happen in our economy, both, of course, from the point of view of what's going to happen in real estate and interest rates and all that kind of stuff, but perhaps even more importantly, talking about policy changes and laws, things like that, you can't just look at one or the other. You have to know both. Because in the end, policy, people's choices, that chases narratives. But what happens with those policies, what happens with those choices, well, that's based on basic economic reality. And so if you want to be a good forecaster, and so far I've been pretty spot on, it's both of those things that you have to take into account. And what I'm going to do tonight is try to give you both of those and give you some sense of how this is going to shake out over the next couple of years, with, of course, a particular focus on real estate and the mortgage market that most of you are involved in. So with all that being said, what has happened over the last year and a half? Of course, 18 months ago, we were in the midst of a national panic attack. If you remember, everybody was saying that we were going to have a recession. It was going to crash on our stores any minute now. The pandemic wasn't truly behind us. The double dip was, of course, going to happen any second. Now, by the end of 2023, it became pretty clear that there wasn't a recession going to happen, right? We all figured that out. But we did see, of course, an increase in overall confidence. You did see inflation start to drop. You started to hear all sorts of conversations about multiple cuts from the Federal Reserve. And the two of those things together caused everything to start to leap forward, right? We saw a stock market start to jump up. Bitcoin started coming back, all sorts of stuff. And you get into this year, and suddenly the next headline from the Wall Street Journal is, "We're the envy of the world." Now, that's a pretty good change in 16 months. We go from a recession is nigh to envy of the world, and if you haven't been paying attention, of course, the stock market just crossed record lines. Now, as I have already noted in this particular conversation, I go a little deeper into it. What has caused this magic turnaround? What has brought us to this wonderful place? Well, of course, it all has to do with the magical, wonderful leadership of the man at the helm of our Federal Reserve, a man by the name of Jerome Powell. Again, work with me. This is narrative. Or more specifically, this is the wrong narrative. This is not at all what happened over the last 18 months in our particular world. It's as simple as that. And it brings me to one of my favorite quotes of all time, which is, "An economist is an expert who will know tomorrow why the things he predicted yesterday didn't come true today." And that's very much what I think a lot of forecasters are currently struggling with. What happened to this much vaunted recession? Well, we didn't buy into this. Again, I think if you pay attention to narratives and you pay attention to numbers and you recognize that these two things move in different directions, you will very quickly begin to understand why we didn't think there was any chance of a recession hitting our economy over the course of the last year and a half. That is not the fundamental issue that's happening in our world today. Basically, it all boils down to this. First of all, there was very little chance of a hard landing. Why? Well, ask yourself why we would have a hard landing in the first place. What was the big negative things hitting our economy that were so terrible and tragic? Well, the answer, of course, is inflation, which is supposed to crush the consumer, and rising interest rates, which was going to crush real estate. But you see, that's an interpretation of those two things that is completely wrong, because in that interpretation, it looks at rising interest rates and, of course, the hike in inflation as some sort of negative shock hitting our economy that was delivered to us by some, I don't know, evil external influence. They weren't. In fact, rising interest rates and inflation were the consequence of the excessive stimulus the Federal Reserve threw at this economy in response to the pandemic. What you saw was an economy that was violently overheated, and since that point in time, the only thing that's happened is the economy is cooling down to something less than white hot. That is not a recession-causing issue, period. As for, of course, this is hard without a monitor over here. As for the story of housing itself, yet again, what interesting times. I get in a little bit of this data. And housing, again, was supposed to collapse. We know sales are down. There's not a lot of turnover, as the case may be, but housing has been rock solid. And that's because, of course, the two offsetting effects in the housing market is, yes, it's become more expensive to buy a house, but guess what? There's nothing to buy. And the combination of the lack of supply with those higher interest rates has created an illiquid market, but not a market where there's a lack of demand. And indeed, we have a very interesting world, whereas the resale market for homes is at near a record low level, yet the new market for homes is actually bopping along at a pretty good pace. Now, that's a weird world. Those two markets typically are correlated by 0.999. For them to move in completely opposite directions like this, well, this is truly unprecedented. And yet again, it goes back to the idea the Federal Reserve has been, shall we say, a little out of control over the course of the last few years. As for our fair state, I heard, of course, that Chris has taken his company and moving it out of state at some level. I think a lot of the places you're moving into sound like great places as well. But I wouldn't quite give up on California just yet. Yes, you pick up the paper and you hear all sorts of news about the end is nigh in California. Well, that's not quite what's going on. In fact, California certainly has some issues, but yet again, it's a difference between narrative and reality. The true issues we have, that is to say a lack of housing, are not being fully acknowledged. The real problem is that the problems they think we have, which of course has to do with screaming inequality and renters who can't pay their rent, well, they're reacting to problems that don't exist, and they're more or less ignoring the problems that do. That is an issue. But putting that to one side, get the policymakers out of the way, the rest of the economy looks pretty good. And in fact, I'm going to give you some numbers that suggest California may still be one of the best places to continue to invest in real estate. But of course, the biggest issue of all this year is not the economy in any stretch of the imagination. It's not the economy that should scare you. It's this election. I mean, we are in June. We are a few months away from election between, well, let's just be candid, two candidates who may not be there in a few months to actually run for president. Now, I don't know who's going to win, and candidly, I'm not sure I want either one of them to. But with that being said, let's understand what's propelling this insane degree of anger driven by a lot of problems that don't actually exist. The problem in our world is narrative. It's not reality. And that's the scariest thing of all. So, jumping right into it, let's get right into what has happened over the course of the last year. It's actually been a fairly good year, all said and done. Real GDP growth has been moving along at a nice pace. We had about 2.5% growth last year, which is a good steady number. If you look on the right-hand side, this is contribution to growth in various sorts of categories. Everything was kind of leading, if you will, to overall growth rate. If you come into the first quarter of this particular year, you can see the economy slowed down just a little bit, but be careful about that number. When you talk about the slowing in the first quarter, it wasn't a slowing in demand. Demand kept growing, consumers kept buying, businesses kept investing. What you just saw was a whole bunch of imports coming in to feed that need. That's not a real slowdown in the economy. As long as demand keeps chugging forward, the economy will come along behind it. And of course, if you go ahead and throw in what's going to be happening in the second quarter, we have some preliminary numbers from the GDP now from the Atlanta Fed, and that suggests, it's probably another 3%, 2.5% quarter. So this economy just keeps growing. What's, of course, pushing all this forward? Well, it's the American consumer. Remember the American consumer who supposedly can't feed their children and give grandma an important prescription drug? Well, if you look at the data, actually Americans are having the time of their lives. Foreign travel is at an all-time high level. Restaurant spending is 40% higher now than it was before the pandemic. Let me repeat that, 40% higher than it was before the pandemic. This is one of my favorite numbers. Alcohol spending. Real alcohol consumption is up 20% from where it was in 2019. In 5 years, we've increased our alcohol consumption by 20%. Now, at the very beginning of this, we were buying it at CVS and we were drinking in our bedrooms quietly in the corner because we couldn't go anywhere or see anybody. But now we're getting drunk in public with other people again. I think this is a positive change. Exactly. Las Vegas has never been busier. Have you? I mean, you can't get it. You can't get a cup of coffee in Las Vegas right now. It's so busy. Gambling revenues at an all-time high level. If you want to be upset or jealous about somebody else's 10K, take a look at Live Nation's profit statement last year. I mean, these guys were printing money. Every single concert they put on sold out completely. Every single concert, including every single VIP package. Has anybody else noticed how every 78-year-old rocker is trying to slide into that old pair of spandex for one last tour? You know, there's a reason for that. It's called the profit motive. You can sell the tickets, you can get on stage. Doesn't matter how bad you look and sing, you'll still get somebody to come to your show right now. As for, of course, overall distress, you've heard a lot about credit card debt and how terrible and tragic that is, but you take a little closer look and actually things look pretty good. There's still almost no bankruptcies. Bankruptcies are less than half of what they were prior to the pandemic. Foreclosures, still largely non-existent. We've never seen fewer foreclosures than we're seeing right now. If you look at the overall debt level, you look on the left-hand side, this is overall consumer debt. Overall delinquencies, again, near an all-time low level. You don't see any of this financial distress. And by the way, that's true with the banks as well. Take a look at bank delinquencies and bank charge-offs on the left-hand side. For all those troubles you may be hearing about commercial real estate, bank loan portfolios are rock solid. They're rock solid. There is not overall problems in our lending market right now. This isn't the issue hitting us. This doesn't look anything like what we were seeing in 2009, 10, and 11. As for labor markets, they've cooled down a bit. There's no doubt about it. But by cooling down, we went from adding 400,000 or 500,000 jobs a month, which, by the way, is not sustainable in any stretch of the imagination, to about 200,000 jobs a month, which, by the way, is still better than was prior to the pandemic. Of course, overall job openings, prior to a couple of years ago, remember when I said the economy was white hot? One way you know it was white hot was by looking at the labor markets. At one point in time, there were 2 job openings for every single unemployed person in this nation. 2. In fact, I don't know why anybody was unemployed. How can you not find a job when there's 2 job openings for anybody looking for a job? And of course, with tight labor markets, wages have been rising. I know that hasn't been reported in the New York Times recently, but yes, real wages are growing at about 3%. The overall unemployment rate in the United States remains about 4%. These are good numbers. How about in business investment? It is true, interest rates are up. We know the 10-year bond is still running close to mid-4s. The mortgage rate is running about 7 right now. But despite that huge hike in interest rates, business investment looks good. I mean, you look at the numbers across the board, manufacturing structures, software, research and development, even, of course, overall residential structures, showing a little sign of life. Actually, we're investing. It turns out that the cost of capital is not the predominant driver of business investment. It's a driver, but not the predominant driver. The predominant driver of investing is demand. If there is someone who's going to buy what you're going to produce, you will do it. You will figure it out. And, of course, that interest rate is just a cost of doing business. As I've been noting, the economy is doing fine, and therefore they're not paying much attention to that rising interest rates. They're moving forward steadily. And, of course, overall home sales. If you take a look at the left-hand side here, all my graphs are changed. I'm not exactly sure what happened here, but we're going to work with it. We're going to be happy with it. Existing home sales there on the left-hand side, you can see that, yes, it's near an all-time low level, right? As bad as it was in the middle of the Great Recession. But with that being said, nothing else looks like that. I mean, consider just for a second that interest rates, mortgage rates went from 2.5 to 7.5% in about a year and a half. We've never seen anything like that. 2.5% to 7%, one of the sharpest rises in mortgage rates we've ever seen. And yet home prices fell, I don't know, for like 4 months. And that was it. They hit bottom, and now they're rising. And we just got another number. They're at an all-time high level. By the way, I saw a guy taking a picture. Will someone grab his camera and destroy it? No, we're not allowed to. He's not even paying attention to me. He's too busy texting it off. Hey, listen, at the end of my presentation, there's going to be a QR code. And if you want to get all the slides, get a picture of the QR code, and you'll get a PDF of them. So you can process them on your own time. So yet again, home prices are on the way up. New home sales as well. I already mentioned, existing home sales are down, but new home sales have been coming up very nicely. And as a result of that, single-family permits have jumped up. Right now, single-family permits are running about 1 million units a year. Okay, not quite as hot as it was at the beginning of 2022, but better than at any point between 2009 and 2019. Who would have expected that, right? So this is not an economy that, of course, is collapsing into some sort of massive downturn, as the case may be. This is economy is trucking along just fine. Now, there, of course, are all these drivers into the end of the year. Inflation has slowed down. Consumer confidence starting to pick up. I talked about the stock market going up. I mean, Bitcoin. Have you seen Bitcoin? I'm not even sure what it is now. The other day it was like $68,000. Anybody have a current read on what Bitcoin is right now? About 60,000, right. Okay, so that's only about $60,000 different than its fundamental value, right? And I have to have this conversation all the time. Why is Bitcoin worth zero? I don't have to tell you. Let me just suggest a wonderful book. It's a biography of an Italian-American gentleman by the name of Charles Ponzi. Lived about 100 years ago. You know, it's a wonderful rags to riches to jail to deportation story of a true American entrepreneur. But this, of course, brings me to my very dark slide. I'm not sure what happened here, but we'll figure it out later. There are narratives and there are reality, right? And these are not the same thing. And this has been something I've had to kind of get into my head over the years because we were trained that this didn't work. Now, when you think about this, these are this kind of basic Venn diagram, and you think there are things that are social narratives but not part of economic reality, things that are economic reality but not part of our narrative. Great example, of course, is the first. It's the positive value of Bitcoin. Now, snark aside, there's a very simple reason why Bitcoin shouldn't be worth a damn thing. And it's not because, you could just have more Bitcoin. You can't. There's a limited number of Bitcoin. True. But any kid with a master's degree in computer science can make another cryptocurrency. You see how that works? If you can have an infinite number of cryptocurrency, how can any of these things be worth anything? But it is. Logic aside, if I wanted a Bitcoin, apparently it's going to cost me $60,000. Now, why? How? What? But put all that to one side. This is the world we live in. Read the websites. Listen to the stories, the narratives, the puff clouds of total bullshit these people tell each other, right? But in the midst of all that noise, real value emerges like magic. I mean, honestly, forget the snark. I wish I could figure out how to do it myself. I wouldn't have to work anymore, right? What a great trick. But with that being said, it's also not a new trick. Does anybody here invest in gold? Gold's near an all-time high level, too. Why? I don't know. Couldn't tell you. Well, because of inflation. Well, what do you mean because of inflation? Well, gold's an inflation hedge. Well, actually, anything with a price is an inflation hedge, right? Think about it. Inflation goes up. That means all prices go up. You see that? So if you buy a chair, that's an inflation hedge. Now, I get it. Okay, gold's valuable because 100 years ago we used it as a basis of currency. Okay, I agree with that too. And 100 years ago we rode horses to work and we beat our wives on a regular basis. What's your point? This is not that world. Now, again, my logic aside, it doesn't matter. If I wanted to buy an ounce of gold, it's going to cost me X amount. That is the narrative. That is what the market's driving. But if you invest in gold, you invest in crypto, there's nothing fundamental. You're betting on narratives, and that scares me to death. I like real estate because you're not betting on a narrative. You're betting on a dividend, a rent. And that, to me, makes sense. But, again, everybody's going to have their own thing. Now, the other side of it, of course, the unsustainable federal deficit. This is another enormous problem in our world. We know that. right? At $1.9 trillion, we're talking huge increase in interest expenses. We have the highest debt to GDP ratio ever. We just surpassed where we were at the end of World War II, to give you some sense of how much money we borrow. Clearly, it's not sustainable, but it's not part of the narrative. Why do I say that? We're going to have an incredibly ugly election this November, right? And yet, I can almost guarantee for all the people who go and vote in November this year, are they going to pick a D or an R on the basis of which party has a better plan to deal with the deficit? Oh, hell no. Everybody's got 100 other angry reasons why they're going to hit that D or that R. And none of it has to do with the deficit. And by the way, both parties know that. How do I know they know that? Because neither party has a plan to deal with the deficit. One of the things to keep in mind, it's so easy to poke fun at politicians. Oh, you silly people, how could you be doing this stuff? No. Politicians win or lose on the basis of grabbing the right narrative. If they're elected, it's because they're telling us what we want to hear. So in the end, it's our fault, not theirs, because we're not telling them to do it. Now, there is the magic place in the middle. I like to point out that the magic confluence is Ticketmaster, because we all know it's narrative and reality. Ticketmaster, complete, total thieves. They are ripping us off, right? Now, why is this important? Suddenly, it comes together. I'll tell you why it's important. Because when you have this magic world, well, this is when the right things happens. Finally, narrative, reality come together, and the Justice Department is pursuing the right policy. And that's the key. If you want the right policy, you got to start with the right narrative. Bad narratives lead to bad policy. It's so critical that our narratives be aligned with reality if we're expecting our government to do the right stuff. And that's what, again, worries me more than anything else. Our narratives are so far off base, I don't know where to even begin. Now, when you start thinking of the world this way, narratives skewing interpretation of news, narratives the root of economic goals, narratives driving these bad policy choices, you start to realize, wow, yeah, you can see this everywhere. But even here, it's not new. There's nothing new. We've all been said before. One of my favorite California philosophers, a guy named Will Rogers, who said, it isn't what we don't know that gives us trouble, it's what we know that ain't so. That is wisdom for the ages. But no, he's talking about bad narratives. It's exactly what he's talking about. Everything I just told you, he talked about 100 years ago, right? Simple as that. Now, oh boy, all my graphs are really dark here. When you get these in PDF, they'll be a lot better. How did this all begin? Well, of course, it all goes back to the pandemic. And the pandemic was obviously a terrible social situation. We were stuck inside for a year and a half. Millions of people died internationally. But with all that being said, it wasn't the end of the world economic shock everybody said it was. Quite the opposite. It was a very large but very brief recession. We got hit second quarter, biggest downturn ever. But it was also the shortest recession ever. It lasted about 8 weeks. Really, 8 weeks. By the third quarter of 2020, the economy was rocketing back. By the first quarter of 2021, we were almost back to normal, completely healed by the second quarter, right? But don't bother with reality. Just talk about the narrative. Oh, boy. Can you start that again for me? I don't know what's going on here. Okay. So what did they do? How did they respond? Well, the pandemic recession cost the U.S. economy approximately $1.2 trillion in income. That's what it cost, that whole little shutdown we went through, about $1.2 trillion. Well, in return for our $1.2 trillion income hit, and of course being stuck inside for a year, Congress decided to deploy $6 trillion of fiscal stimulus. That's $5 of stimulus for every dollar of lost income. Of that $6 trillion, $5 trillion was, of course, created by the Federal Reserve itself in the form of quantitative easing. I like that term, quantitative easing. It sounds so much better than we printed money, doesn't it? All right? But quantitative easing. Obviously, that's $5 for every dollar, but that's $50,000 for every single person. $50,000 in stimulus. Gee, I wonder why the economy took off. But it didn't stop there. Think about what actually happened here. So the Federal Reserve lobs tons of money, just preposterous amounts at the economy via Congress. That causes the money supply to expand like nobody's business. Everything there is perfectly understandable. But what happened behind that is what's critical, because that set off a massive increase in asset prices. Don't you remember in 2021, home prices went up, the stock market went up, Bitcoin went up, everything with a price went up. And how much did that go up? Well, think of this. $5 trillion in brand new money turned into $35 trillion of brand new household net worth. That's $300,000 additional money for every single person in the United States. And this is what's interesting. The Federal Reserve has been stomping on the brakes for the last year and a half, and I'll come back to that a little later in this presentation, stomping on the brakes for the last year and a half. And they have, yes, slowed inflation. They've shrunk the money supply. They haven't done a damn thing about the financial markets. Asset prices cooled off for about a half a year, and they've shot up to all-time high levels again. So our economy may be cooling off because of Fed policy, but it is more than offset by the fact that asset prices are at this ultra-high level and continues to fuel overall demand. And when you take a look at the numbers, well, it's absolutely understandable what happened to our economy over the course of the last couple of years. All these people had all this money, and they went all partied. Just look at the numbers. This is the biggest increases in nominal spending by Americans, top to bottom: air transportation, pickup trucks, foreign travel, sporting equipment, including guns. That one scares me. Pleasure boats, video equipment, live entertainment. And then you get to the bottom: utilities, food, rent. No, people weren't drowning in a sea of inflation. They were partying like nobody's business. And yet, we've invented a completely different world. Now, extra money, lots of demand, that equals inflation. There is no absolute debate about this. In fact, one of the biggest cliches ever is inflation is caused by too much money chasing after too few goods, period. That's how it works. But again, that's not the story we hear anywhere. Every time I hear a political leader get up, all they talk about is how Americans are being crushed by the scourge of inflation. It's not how it works. Americans are creating inflation by excessive demand, period. That is how it works. Yet, of course, that narrative doesn't work in political land, ergo we continue to run around talking about the exact opposite. Now, inflation has cooled off. We know prices are down, but demand hasn't cooled off. That's still running hot. Now, it's shifted a bit. People are spending more money on housing and utilities, more on financial services, insurance, more on food services and accommodation. They're spending less on cars, less on gasoline, less on furnishing, right? They're moving away from goods, they're moving back towards services, but it's a shift in demand. It's not an end in demand. People still continue to expand and they will for a while. Why not? Take a look at the left-hand side here. This is checkable deposits for American households. Prior to the pandemic, every American household aggregated together, combined, held, about $1 trillion, a little less than $1 trillion cash on hand. Right now, Americans are sitting on almost $4 trillion cash on hand. $4 trillion. Just, again, let that rattle around your head. And, of course, remember that most household debt is in the form of this wonderful thing called a 30-year fixed-rate mortgage. And what is it? Typically 2.5% to 3.5%. The good old days. And, of course, they're not walking away. And so for all the increase in interest rate, debt burdens are not going up in American households. Quite the opposite. They're still near record low levels. So Americans are fine. There's plenty of demand. They're not going anywhere. And if the American consumer is fine, the rest of the economy is fine. American consumer spending is almost 70% of our economy. If the consumer is healthy, everything gets pulled along behind. It doesn't matter. Everything else is secondary. And that's what's going to continue to push our economy forward. Now, with all that being said, let's also be a little bit honest about things. For all these scary stories out there, the inflation rate over the last 5 years, it really wasn't the end of the world. I mean, we had 1.5 years, 2 years of bad inflation. After 3 years, incredibly low inflation. The average inflation rate over the last 5 years is roughly about 3.2%. 3.2%. That's it. 5 years, 3.2%. That's what all this whining and complaining is about. By the way, 1979, in 5 years, the average inflation rate was nearly 9%. That's inflation. This isn't inflation. What are we talking about, right? And of course, even interest rates. For all the whining about interest rates, let's be clear. The weird time for interest rates is not now. It's the last decade. The last decade was bizarre. Real interest rates for almost 6 years was zero. On what planet are real interest rates zero? That makes no sense. Now we're getting back to things looking like normalcy again. So I want you all to keep that in mind. We're going to come back. You asked, well, what about interest rates? They ain't going anywhere. That's the answer. If that's all you wanted to hear, go ahead. You can leave now. All right? They're not going down again because they shouldn't have been that low in the first place. Now, there's other reasons too, which I'll come back to, but they shouldn't have been that low. Now, it's not what you hear. Again, I like this. This is one of these surveys that came a couple of years ago. 85% of Americans are feeling impact of inflation in day-to-day lives. 85% of them. Wow, 85%. Now, go to the second bullet just for fun. A similar number, 88%, said inflation has impacted their spending at restaurants. Now, I just showed you the data. Restaurant spending is up 40%, people. Whoa, what? Now, there's two explanations for this particular survey result. One explanation is the other 12% of people are spending a lot of time in restaurants. It's possible. It's possible. But probably more likely is this. People aren't reporting what they actually did. They're reporting their narrative. And that's a key thing, something we always forget. You know, there's data and there are surveys. Data, well, that's facts. Surveys, that's narratives. Whenever you read a result of a survey, this is what people are thinking, not what's actually happening. One of the biggest mistakes you can ever make is to look at a survey and think this is real. It's not. It's their personal narrative. It's not reality. Now, it's still important. We still need to know it. It's good to know what people's narratives are, but it's not reality. Or how about, of course, your typical Gen Zer? Boomers can't conceptualize. This college student on TikTok says older generations don't know about inflation, never had to fight for jobs, and the comments are in full support. Now you know why we need to ban TikTok. This is the one and only reason. No. Again, we're picking on Gen Z. It's not fair. How about The Economist magazine, right? The august institution that is supposed to be data-based, economic theory-based. What do they say? Could the inflation nightmare soon be over? Well, what nightmare? That it's going to take, 7 months for my brand new BMW X6 to get delivered? What nightmare are we talking about? Again, the data we hear about makes no sense whatsoever, but of course, this is what drives the policy. Now, where does this come from? And I'm not going to bore you with all this. There's lots of wonderful literature. I've been diving into it. One of the best of this, Daniel Kahneman, a researcher in psychology who won the Nobel Prize in economics because of his insanely powerful insights in how people make decisions. And what he talked about in this book, Thinking Fast and Slow, was the idea that we have two ways of thinking. We have our new system and our old system, our type 2 and our type 1. The type 2 system, that is your calculating brain. That is what helps you figure out these incredibly complex financial spreadsheets you might be indulging in, or how scientists figure out what's at the heart of an atom, or how old the universe is, right? That's your type 2 brain. Now, type 2 brain, that kind of thinking, is what has made humanity humanity. But let's be clear, we're only a little advanced, right? I mean, our type 2 system is not exactly the most sophisticated thing. I like to say we're kind of a 286 system in a Pentium world, as the case may be. And what that means is a couple things. First of all, your type 2 thinking can only think about one thing at a time. And the other thing is, when you use it a lot, you get tired. So when you aren't using your type 2 system, what do? Well, you rely on your type 1 system. And your type 1 system, that's your old-fashioned system. That's your emotional brain. It's a rapid brain. It's the brain that kept your ancestors from being eaten, right? It's a brain that it learns how to respond rapidly to limited information. And you know what I'm talking about, right? You're walking down, it's dark, you're in the countryside, you hear some rustling in the bushes behind you, and you take off at a dead run. That's type 1. Type 1 saying, don't get eaten. Now, mind you, you're halfway down the road, and you're like, wait a minute, I'm in Irvine. I can't get eaten here. But type 1 takes over in the short run, and that's the key. If you're not actively paying attention, your type 1 system is what's processing information. It's what's determining what's happening out there. And that type 1 system is keyed to threat. It's keyed to risk. And so what happens if you're not actively out there challenging everything that you see and read, well, your type 1 system starts processing things and looking for risks. And when all that verbiage is out there so negative, you start to think things are really bad. And it's particularly profound because your type 1 system is full of all sorts of what we call cognitive biases, ways that we warp information in ways that aren't really true. And again, unless your type 2 system is watching it, you're not getting it. It's just getting into your head. Now, the easiest way to think about this is, well, we don't think as much as we think we think. By the way, it's hard for people to read this. Let me explain. There's a bunch of people here going to an LA 24-hour fitness up an escalator. You working with me? Clearly not a logical choice. But it's what you do. It's automatic. You're thinking about something, you get on the escalator. Well, that's, of course, preposterous, but this is how human beings operate. Now, again, what this means is very often we bring information to our brain that's not quite true. The real issue in the United States, by the way, is not inflation, it's not interest rates, it's not a lack of consumer spending. It's the fact that we don't have enough people. You remember those incredibly tight labor markets and all these job openings? Well, it isn't because kids aren't working, they are working. In fact, the participation rate for 25 to 50-year-olds is near a 30-year high. The problem is we stopped making people. You know? Overall birth rates have absolutely slowed down, and as a result of that, our population 25-54 haven't grown in almost 20 years. This is our real issue. We don't have labor force growth. Now, this is a critical issue. Our population pyramid is now a population column. Now it's starting to shrink. And this should be something we should all be worried about. Now, what's interesting is there is an offset to the lack of babies. You want to have babies? Fine. What can you do? More immigration. But of course, even there, what do you see? Nothing but turning against it. Now, there's an upside to a lack of workers, and that, of course, has to do with the fact that tight labor markets are good for workers. Now, yet again, not the story. This is what you hear all the time, a baffling academic feud over income inequality. I love this. This is such a typical reporter. Everybody knows inequality's gotten out of hand. Everybody knows that. You're an idiot if you don't know that. The problem is, it's not true, Chief. And this, again, gets to the heart of the matter. All you hear about is how income inequality is the worst thing in our world today, and yet, believe it or not, take a look at the inside. This is year-over-year growth in nominal earnings for the lowest and highest quartile of the wage distribution. And what do you see? Well, actually, the lowest quartile of earners has seen more income growth, earnings growth, than the top quartile for 9 years now. For 9 years. Now, I'm not suggesting for a heartbeat that income inequality is fine and we can just walk away. No. There are still a lot of people out there who need help. Income inequality is still too wide. And the top 0.1%, yes, they need to be taken out into a field and be dealt with in a proper way, with Elon Musk number one on that line, okay? But with all that being said, the vast majority of us are, in fact, enjoying a better quality of life. And take a look at the right. The overall U.S. population in poverty, record low level. Again, think about these numbers. Think how things are going. And yet, you hear nothing but the opposite. Or, of course, there's the story about, well, maybe income inequality isn't good, but we're never going to be able to buy a house, right? We're never going to be able to buy a house. Simple as that. And this is one of those standard sort of memes on the internet. You get it, boomer. 1980s, home price was $80,000. Your down payment was $16,000. Your salary was $30,000. Half a year. See? Nowadays, home price is $400,000, down payment is $80,000, your salary is $50,000. Don't you get it, boomer? It takes me a year and a half to buy a house. It took you only half a year. It's not fair. Now, to be clear, these numbers are all wrong. If you look a little deeper, you'll find that actually, well, incomes aren't quite that low. I'm sorry, let me just get through this. The things are all messed up. Turns out home prices aren't quite that high now. Nor are incomes quite that low now. And then he conveniently forgets, of course, this thing called, what is it called? Interest rates, which has a lot to do with it as well, right? And then it even gets more absurd. Just take a look at the houses. Just look closely. Does anybody notice the one on the right is a hell of a lot nicer than the one on the left? I mean, it's got a nice lawn. It's got a garage. It's got a nice second story. It doesn't have those horrible cost centers on the front stoop. What are those things called? Oh, kids. None of those in a Gen Z household, right? What are you talking about? Now, I get it. Everywhere you pick up a paper, we hear about nothing about how unaffordable housing is. Everything's terrible. Everything's tragic. Nobody can afford a house, right? Simple as that. And by the way, that's exactly what we said back in 2019 too. Now here's the actual data. Work with me here. If you look on the left-hand side here, what you see, of course, is an estimate of what I call actual affordability. This is a very simple metric. I did 100% loan-to-value of current interest rates, compared what annual payment would be with little taxes in, and then I compared it to incomes. And what's interesting, of course, the worst affordability was, not too surprising, when interest rate at 18%. And then it got better and better and better. And after the Great Recession, we entered one of the most affordable period of time ever for purchasing housing. For that 5 or 6 or 7 years to the run up to the pandemic, we've never had cheaper housing. And yet, everybody was told housing is going to be, is too expensive. Did anybody else remember in 2019 how we were all told that home prices were absolutely going to fall because they're too high? Do you remember that? Total nonsense. Made no sense. But this is what people heard, and this is what they thought. This was their narrative. And go back to just how cold that housing market was in 2019. Even I was perplexed, because everybody's like, see how cold it is, Chris? We told you it's overvalued. But see, that's the key. This is the power of the narrative. In my Chicago world, it doesn't work that way. There's an old joke in the Chicago School of Economics that works this way. There's an older and a younger Chicago economist walking across the University of Chicago campus. And the young economist looks down and he sees a $50 bill on the ground. He says, hey, there's a $50 bill on the ground. This is great. We're going to, I'm going to go get it. And the older economist just looks at him and he goes, don't be an idiot. And the guy's like, what are you talking about? He goes, don't be a fool. Don't say that. What do you mean? He goes, look, if there was a $50 bill on the ground, somebody would have picked it up by now. That's the Chicago School of Thought, right? That's how they think. But it doesn't work that way. People do lose $50 bills, and other people find them. Now, what happened back in 2019, well, everybody was told home prices were going to fall. Ergo, nobody bought, which made the housing market colder, which convinced more people prices were going to fall. And it became this weird, vicious circle that caused the market to get colder and colder and colder, because everybody was waiting for something that wasn't going to actually happen. Well, then you leap into the pandemic, and what? What happens? Well, I'm saying roughly August of 2020. This is how I see it. August of 2020, piles of money are pouring into the economy. Interest rates are ultra low level. People are saving money because they can't do anything else. And they said, I'm tired of waiting. We've been waiting for 3 years for home prices to fall. We got piles of cash. Interest rates are low. Damn it, honey. I heard there's an open house down the street. Let's go take a look. And they said, great. And they got their masks on and they walked down the street to see the line of 947 people who had exactly that same idea that morning. There were 57 offers on that particular day, and the house sold for 35% above asking value. Boom. Cue one of the most insane market rallies in the history of the United States. Home prices went up by 50% in 2 years. Well, obviously, that was accompanied by the overall overheating of the economy. Interest rates went up. Boom. Suddenly it became unaffordable, and the party was over. But to be clear, owner finances are great because people didn't have a lot of debt. They're all locked in those low interest rates. In 2015, there was $8 trillion of household equity, housing equity in the United States. $8 trillion. Right now, I got to look closely. Where are we? $32 trillion. Household equity has gone up by a factor of 4 in 10 years. Let that rattle around your head for a while. There is massive amounts of wealth sitting in our economy. And as already noted, with low mortgage rates, no one's moving. Why would you? So here we have an existing home market that is incredibly cold. But it's not cold because no one wants to buy. It's cold because no one wants to sell. Now, this brings me, of course, to the other part of the equation. Because not only was everybody running around thinking housing was too expensive, but of course builders were listening to that too, and they saw a lack of demand. They weren't building. So not only do we have a lack of existing homes for sale, but we have a lack of anything to live in. We had an incredibly weak decade of overall housing supply growth, and the result of that is we have one of the tightest housing markets we've ever seen from a pure physical standpoint as well as from an existing home inventory standpoint. This is a tight market, and that is a market where, yeah, new home sales can thrive. Now, it's a weird new home market. It's a very interesting world for guys, because remember, there's not a lot of liquidity. And really, to make a housing market work efficiently, you have to have a lot of liquidity. We call it filtering in economics. Hey, I build a fancy new house. This guy buys this one. This guy buys this one. This guy buys this one. This guy gets the entry-level house that just became available. It's called filtering, right? Filtering is broken down. That's not happening because nobody's buying and selling. So the result of that is if you are a builder and you build the right thing in the right place, you will sell it immediately and make a handsome profit. But if you're not building the right thing or in the right place, you have a bigger problem on your hand. And of course, that is why we have these mixed markets. Most builders are pretty smart, and they're doing pretty well. I've talked to any number of builder groups over the last year or so, and for the most part, they're smiling. Real estate groups, the residential real estate group, they don't even invite me. They have no money. But the builders, they're doing great, and that's the situation. And that's why sales are up, and of course, guys, I'm having a little technical problem again. Guys? There we go. Okay. New home paradox. Got it. New home sales, again, nice and strong, moving along. California, again, very strong, and it's incredibly low level. Texas and Florida moving along as well, very well. Single-family permits, again, cruising along on a nice steady basis in all these particular markets. Now, there are some cracks. And this is, I think, one of the interesting things about what we're seeing out there. Because while it is true that a lot of people are locked in on low interest rates, they're not locked in on low tax payments, nor are they locked in on low insurance payments. And, of course, when you look at a place like Florida or Texas, where taxes are going up with the price of properties, and, of course, also the cost of insurance, and we know how cost of insurance is going up, and by the way, they don't have state pools over there. Well, you add this all up, and suddenly there are getting existing units being dumped on the market in Texas and Florida. Now, it hasn't turned into what I call a full meltdown. I'm not seeing anything having to do with debt defaults over there. But people are getting into some cost trouble having to do with insurance and payments, having to do with those tax payments, and you're seeing more liquidity come on. And that's one of the interesting things about California. Because actually right now, California remains a stronger market than Texas or Florida, in part because we're not subject to some of these violent whims that, of course, Florida and Texas have been hit by recently. Now, ultimately, from a long-run standpoint, they obviously have strong economies, but I wouldn't quite give up on California. And that, of course, brings me to our fair state, this place we call home, California. Where is California? Now, again, the narrative is interesting. If you listen to the right, just pick up Fox News and, for 5 minutes, you will eventually hear them talk to you about how terrible California is. California is a failing state. We are a failing state because of our socialist policies that are driving rich people and businesses fleeing the state of record numbers. Now, of course, you could talk to the Democrats, and guess what? They will also tell you we're a failing state. But we're a state that's failing our population. We're a state that's defined by, of course, screaming inequality, landlords that are brutalizing their tenants, people who can barely scrape enough money together to feed their kids. We're failing our nation. Now, there's a third opinion out there, of course, and that's the governor, and his opinion is, well, it's fine, don't worry about it, everything's fine, everything's good. No, really, it's a great economy, and I'm going to run for president, right? So, which is it? Are we a socialist disaster? Are we a capitalist disaster? Or are we something in between? And the answer is, actually, the governor's right. We're something in between. We are neither a socialist disaster, nor are we a capitalist disaster. All these narratives that are being applied to California are simply incorrect. Now, I get it. We don't have as much job growth as other states. There's no doubt about it. But, then again, our unemployment rate's still pretty low, and job openings rate's still relatively elevated. We have more GDP growth than the rest of the nation right now. We have more income growth than the rest of the nation. In fact, you ask yourself, well, why don't we have as much job growth as Texas? Well, because we don't have as much labor force growth, which is kind of a problem. You want to hire more people, you need more people. And that's our big problem. We're not adding to our labor force. In fact, while Texas and Florida's labor force is, significantly larger than it was 5, 6, 7 years ago, California's labor force today is roughly what it was in 2018. So, in other words, in 6 years, we've added 0 workers to our economy. That's a problem. That is a problem. That will hold you back. And of course, why are we not adding enough people? Well, look no farther than the housing supply. Texas builds housing. We don't. People move to Texas. They don't move here. This is not complicated. This is a simple situation. It's a lack of people. Now, when you take a look at our labor markets, well, you get a little closer, you realize this problem, and what you realize is our biggest problem is, well, we need more people. In fact, we've lost 1% in our labor force in the last 5 years. We've added 2% to our non-farm payroll labor force. I actually call that pretty good. I'll give that a thumbs up, as the case may be. Now, there are some upsides also to this particular situation, because it isn't just that we aren't growing. What's happening is there are people moving in and there are people moving out. Who's moving in? People who don't care that much about housing costs. Higher income people, younger people without kids, people with disposable income who want to enjoy this phenomenal state that we all live in. Who's moving out? Families with kids, lower income folks, folks who do not or cannot afford these housing costs. Well, this is how the price mechanism works. There is a limited resource. It's called housing. There is a bidding war going on for it. Higher income wins, lower income tends to lose that particular bid. This is how it works. So what you see, high-skilled people moving in, low-skilled people. Look at the changes in demographics. In the last decade, it's been a 17% decline in people on our labor force with less than a high school degree. There's been a 26% increase in people with a bachelor degree. What we are seeing in California is massive gentrification. That is what's happening in the state of California, is gentrification. I'm not happy about that. I'm not. I don't want to live in Country Club, California, okay? I want to live in California where has room for lots of people. But at the same time, gentrification is not typically what you would associate with a collapse in Western civilization as we know it. But that, of course, tends to be the stories about this. And of course, if you take a look at household incomes, our household income has been growing much faster than Florida or Texas, and right now is among the highest in the nation at this particular point in time. Good, steady numbers. Now, wait a minute, what about these population declines? We just went through 3 years of population declines. We heard that those people are fleeing housing costs. They're fleeing our socialist policies. They're fleeing, they're fleeing, they're fleeing. I love that verb, fleeing. Now, let's work with the narrative wrapped around fleeing. If people are, living in Miami and they're fleeing a hurricane, what happens to housing vacancy rates? They go up. Fleeing means higher vacancy rates. What's our vacancy rate right now? Well, as it turns out, there's population decline. Fleeing? Well, right now we have record low vacancy rates in California housing. Let me repeat, record low vacancy rates. That's not fleeing. That's not how it works. In fact, here's where it makes a little more sense. How can we have record tight vacancy rates when people on net are leaving the state? Well, the answer is we have fewer people, but we have more households. Fewer people, more households. Take a look a little closer, and you can see it a little better. Take my fair county of Los Angeles. In the last 8 years, in the last 8 years, LA has seen a 4% decline in its population. It's seen a 5% increase in the number of households. If LA wanted to keep its population constant, it would have had to have expanded its housing stock by 9% in that 8 years. LA doesn't build housing at half that pace. Ergo, when people start spreading out, when they don't want to live with somebody else, someone else, by definition, has to get pushed out. Why are people spreading out? That is a function of prosperity. I like to say, what are the worst 3 things you could possibly live with? And the answer, of course, is bed bugs, cockroaches, and anybody you're not related to, okay? People move out. That is their choice. And because they're spreading out, they push people out. They push them out of state. They push them out of the county. Or, worst case scenario, they push them into the alley. Think about what's going on. Think of the story about homelessness. They can't fix homelessness. Why? Because their narrative is wrong. The story of homelessness in California is a function of the tragic plight of our renters. These renters are being crushed by rents. They can't afford it. Ergo, they get anything happens. One little problem in their life, one medical emergency, bam, they're homeless. Now, if you believe that, you think that protecting renters is the way to prevent homelessness. We need eviction moratoriums. We need rent control, right? We can't let those evil landlords toss those people into the street. We must protect them. But if you recognize that, in fact, homelessness is a function of the prosperity of renters, then you realize that rent control makes the problem worse because people have even more reason not to live with anybody else. Eviction moratorium, why bother paying rent? You're not helping. You're making the situation worse. And you're not going to fix homelessness until you recognize homelessness is not a problem of the broader economy and inequality. Homelessness is a problem of that individual combined with the overall lack of housing. You need to build more housing, and you need to fix that person. It's a different kind of conversation. But you will never fix this until they get the story right. And that's the most tragic thing about it. There are people suffering. But as opposed to helping those people, they're too busy running around trying to fix the economy. Well, that's not going to get you anywhere. And of course, in the end, if you want to make California a bigger state, you got to build more housing. And that's the one place we have consistently failed. We build 120,000, we issue 120,000 housing permits per year, period. We've been doing it for a very long time, for all the promises, for all the new rules and regulations. Nothing's changed. Nothing has changed. Now, what about, of course, the Federal Reserve itself? And if you could see this graph, you'd say, what about the Fed? Where is the Fed? Now, how do I put this? Jerome Powell is not an economist. He's a lawyer. But then again, most of the people running the Federal Reserve right now are not economists. They're not bankers. In the last 20 years, the Federal Reserve has become politicized. And as a result of that, the people who are running the Federal Reserve, who are on the various board seats, these are not bankers and economists. These are people who chase narratives. They're politicians. Now, they're not politicians that are running for office, but they did lobby for their positions. They said the right thing to the right people in Congress, the right people in the White House to get that particular job. They lobbied for it, and as a result of that, they're chasing narratives. And the narrative coming from the Federal Reserve right now is very simple. We didn't cause inflation. Wasn't us. It happened because of an exogenous shock. But now that it happened, it continues because of expectations. And by the way, in their world, inflation's been terrible for American households, which means they have to whip inflation no matter what, which is exactly why they keep, of course, keeping the market very, very tight. Well, this is the official story. I'd be curious to know what is really going on over there. Because let's say at some point in time they really did figure out they overdid it. A couple things, they're never going to admit it. The one thing that makes people really angry is inflation. Even if it didn't really have a consequence, we are amazingly sensitive to price changes. Ergo, everybody's angry, and if they acknowledged that they were the cause of inflation, I don't know what might happen. Perhaps Congress might say, hey, you know what? You guys are doing a bad job. We're going to take over. And by the way, as much as I dislike Jerome Powell, I much prefer him than Congress running the Federal Reserve. So maybe gaslighting is the right way to go, right? But more importantly, then what is he doing? Why is he continuing to keep things so tight? Well, there's a couple reasons. One of them, of course, is, well, stock market. Look where it is. It's at an all-time high level. Look at Bitcoin. Look at these asset prices. This looks frothy. This looks like a bubble. Can you really back off in that kind of circumstances? Not really. Now, we did hear, of course, at the end of last year that we were going to have multiple rate cuts over the course of this year. And honestly, that was one of the most bizarre narratives I've ever heard in my entire life. Not a shred of evidence that that was going to happen. Oh, they just kept repeating it. The financial press loved that story, and the markets loved that story. And what happened? Powell just kept saying, we're not going to cut rates. We're not cutting rates. We're not cutting rates. He went on 60 Minutes. We're not cutting rates. And they haven't cut rates. And we went from 4 rate cuts to 3 rate cuts to 2 rate cuts. Now we expect 1. What are we talking about, right? But here's the dumbest thing of all about this entire conversation. The federal funds rate, completely irrelevant. It's completely irrelevant to every single person in this room. You don't care about that. You care about long-run rates. And by the way, the relationship between short-run rates and long-run rates, not very tight. Now, what is keeping long-run rates high? Well, on that particular basis, the Federal Reserve has no power over long-run rates. They have a little bit of control over the supply of capital. They don't have much control over the demand for capital. And ultimately, what drives interest rates in the long end of the curve, supply and demand capital. Simple as that. Now, what's the two things that they have done? First, they cranked up the federal funds rate, but then the second thing they did was they started to engage in quantitative tightening. Quantitative tightening is the opposite of quantitative easing. They put out $5 trillion in brand new cash. They have now since sold off $1.6 trillion of government bonds they had on their books. They've taken $1.6 trillion of that $5 trillion out. They put it in whatever the official money toilet is in the Federal Reserve and flushed it. It's gone. So they've taken out over a third of the money they put in. So they're moving to shrinking the money supply down. Now, mind you, it hasn't had much of an impact on the asset markets, which is exactly where the Federal Reserve is having a problem. They don't care that they care about inflation, they care about asset prices. They're slowing inflation down, they're having no impact on asset prices. So they have a real problem on their hand. So they are continuing to do quantitative tightening to try and cool things off, which is exactly what's keeping interest rates high. That $90 billion a month, which they have been and continue to pull out of the economy, that is what's keeping mortgage rates high. Simple as that. And that is not changed. Whatever the conversation about the federal funds rate, they are continuing $90 billion of quantitative tightening, and that is why interest rates are high. Even if they started to cut short-run rates, the only thing they're going to do is unwind the yield curve. Do you know the yield curve has been inverted for over a year and a half, almost 2 years now? It's been inverted. So, yeah. Now, why is it inverted? This is a question I've wondered, right? Why would anybody buy a 10-year bond at, 4.5% when you can get a 1-year bond at 5%? And, of course, the answer from all these wonderful financial advisors out there is that you really want to lock in on that 4% rate before those rates go plummeting down again, which is exactly why I would never, ever, ever, ever listen to a financial advisor. That's nonsensical. Why would interest rates go plummeting down again? This is some bizarre world of wishful thinking. Eventually, the market's going to figure it out, and long-run rates will have to rise above short-run rates because that's the only natural equilibrium. And when that starts to happen, maybe then they cut the federal funds rate. But at that point in time, you're just, again, spreading the interest curves out. So the answer to all this is you should invest in adjustable rate mortgages. You're absolutely right. Sheer genius. Because if you think they're going to go down, you want fixed rate. If you think they're going to go up, you want adjustable as the lender. If you're a borrower, it's the other way around. So I like that idea. It's a good move. But of course, it's not just that issue. There's also a lot of borrowing. Remember that federal government debt I was talking about? This huge increase in federal spending? That's a big problem, too, that nobody's talking about. And that borrowing is going to continue to keep things going. But when you get right into it, the biggest legacy, of course, is the fact that this federal debt is going to continue to spiral upwards just on the basis of continuing to see rising interest rates on U.S. government debt. You know, a couple of years ago, they spent less than $500 billion on interest on debt. We're now above $1 trillion. In another year, it's going to be $1.5 trillion. So all by itself, just the turnover of existing government debt is going to cause the deficit to go larger and larger and larger, which means more borrowing, which yet again means upward pressure on interest rates. I don't see any way out of it, unless, of course, they figured out how to raise taxes or cut spending, and I don't see any of that happening in this particular political environment. No one has the will to take on any of those things. But, of course, then there's that longer-run issue, the other issue, the fact that asset prices are high. Whether you look at asset prices compared to the economy or the PE ratio of the stock market, and the fact that Bitcoin is $60,000 more expensive than it should be, everything says asset prices are way higher than they should be, and this, too, is a problem. Because when you think about it, lots of government deficit spending, very high asset prices. Here's a real problem. We're not under-consuming. The way our government's talking about it, you listen to everybody, hey, you're going to hear this presidential debate, and both sides are going to tell you how terrible and tragic you have it, and it's all the other guy's fault. The problem is we don't have it terrible and tragic. If anything, I would argue that Americans are overspending right now. Consumer spending as a percent of GDP went from about a little over 66% to almost 69%. That's too high. Savings rates are well below 5%. That's too low. Externally, our current account deficit is widening. Our net investment position, that is to say how much of the rest of the world's assets we own relative to what we own, they own of us, right now our net asset position is negative 75% of GDP. It's never been this bad. Our real problem is we're on a spending binge, and we're too busy sitting around feeling sorry for ourselves to appreciate it. This is a dangerous circumstance, all, of course, leading up to this crazy election. And I just love it. We had two views here, right, of what's going to happen. One presidential candidate, and I'm just going to read this out loud. Hey, we'll have a little poll. We'll see which one, you can figure out which one it is. One presidential candidate says the U.S. is a failing nation that's descending into a cesspool of ruin. In many ways, we're living in hell right now. Who thinks that's Biden? Biden? Anyone? Anyone? No? Okay. You're right. You're right. Turns out it's Trump. The other one says our future's brighter. America's coming back. We're writing the greatest comeback story ever told. So are we out of the woods? Are we in the woods? What's going on? One says we're coming out of the woods. One says we're going into the woods. And, of course, they're both wrong. We were never in the woods. We were never in the woods. We don't have these problems. The economy's fine. People are fine. They have tons of money. They're not suffering. But yet, that's all we hear. California, we're missing the point. It's housing supply, not housing affordability. We need revenue reform, not higher taxes. We need to stop this nonsense with the minimum wage. You're not going to help anybody by raising the minimum wage. You want to help somebody? Give them more skills, right? You got to upskill them to make them better off. But again, we're not going to get it. Housing, it's demand versus liquidity. Simple as that. But no matter how you look at it, demand is high, liquidity is low. It's a seller's market, period. And that's not going anywhere. As for interest rates, same thing. It's not going anywhere. But ultimately, the scariest thing, not interest rates, it's not the housing market, it's the narrative. This crazy world we live in, where, well, again, everything's great, and we're all pissed off. I've seen this story written. It doesn't end well. My forecast right now, honestly, it's boring as hell. 24 looks like 23. 25 looks like 24. It's just going to keep ticking along. But we're on an unsustainable path. And at some point out there, some economic realities are going to start intruding upon our little world. Asset prices are too high. That's going to cause problems, right? Our deficit is too large. That's going to cause problems. We're borrowing too much money from the rest of the world. That's going to cause problems. But none of these problems are going to get solved until we fix the narrative. And that is exactly what we're having the biggest problem with. So with that, thank you very much. I'll wrap it up there. I know we have a little Q&A for everybody here at the end, so why don't we bring them up.